I know you're a longer-term investor for your clients, but I mean, it seems pretty impressive that with all the fear at the beginning of this week, markets tanked, the VIX soared. Kind of hard to believe we're higher right now. A good lesson in not trying, perhaps, to time the market.
Yes, exactly, Brian, and good morning from New York, and thank you for having me. I 100% agree with what you're saying. It was a really interesting week and a good lesson to not always look to time the market, especially in situations where you see a lot of volatility as pronounced as we had earlier in this week. As you mentioned, we are now, back to be back positive in the week. I think a lot of that is based on, just a lot of investor buying in the bottom of the market, where we saw a little bit of a pullback. And there's a lot of money in the market still. I'm sure we'll talk a little bit about what kind of the monetary policies and what's looking forward. But I think investors in this situation, when you're having this with a lot of liquidity, you want to make sure that you're not timing when you're seeing a lot of pronounced moves in the market there, Brian.
Yeah, let's talk about longer term. You mentioned monetary policy. All right, there's a lot of question marks maybe around the Fed and some of their timing. We're always trying to break out our thesaurus and figure out exactly what they're trying to say. A lot of question about corporate earnings growth. It's been red hot. Will it slow down? Yeah. What's going to happen with, COVID going forward? There's a lot of question marks out there, as there normally are, to be fair. But should we prepare as investors for slower growth, either corporate earnings or GDP, or see all the above?
Exactly right. Yes, there has been a slowdown in projections of growth, right? We're seeing GDP being revised downward. We're seeing estimates on the S&P 500 for EPS growth rate change to be revised downward as well. And so investors, I don't know how much of that is already priced in. So investors want to do a couple things. One, continue to keep your allocation in your divested positions where you'd like them to be. And also, if you have high conviction, some of the growth names and some of the companies that are maybe higher margin could combat some of the things we're seeing, whether it's COVID variants, we're seeing with supply bottle chain issues. You want to stay higher and put new money to work in those areas. So I think investors should brace for a little bit of kind of this exuberance to kind of slow down, and maybe some of that's priced in, but if not all of it's priced in, make sure your portfolio has that clearly spelled out.
All right, Delano, you said defensive positioning. What does that mean to you? Where should our viewers be positioned right now?
100%, Brian. I think one, utilities is always a great place to go. And then that's obviously your low beta. And when you're seeing these pronounced moves, that's going to have the smallest amount of changes as opposed to some of your high beta areas. And so you want to have your allocations there in utilities, in real estate. I think real estate's a great place to be in situations like this because, one, you're looking at demand. We're still talking about a hot real estate market. And that's something that pricing can be passed on, especially for a lot of these real estate companies. And that demand and pricing power can be passed on. So I like staying in the real estate sections and utilities when we're looking for defensive positions. Also, healthcare and pharmaceuticals is a good place to be as well, Brian.